The kids warming out tonight. We had a hot game yesterday. Long walk for the dogs. Started teaching this morning at 7:30 with our international officers. We just started the new year. Finished just in time to go to soccer practice. They kicked my butt all night. Just in time to get back here. Looking forward to breakfast right after this podcast. So there you are. Taking care of first things first. All right, this is the strategy podcast for August 24th, 2020. And counted Tortoise Capital, so here we go. So we closed the week last week with basically a sideways consolidation week. It started it started and finished in just about the same price level. There was not much price improvement all week last week. So we were wondering is this the market tapering off and getting ready for tactical volatility? No, it turned out this was a market that was ready to move decisively up today. There was a nice gap up, a morning sell-off, and then a very strong finish right into the close, finishing, at or near the high of the day, which made a new 10-day high and a new 30-day high within spitting distance of the Z2, and is also within reach of the peak RL10 all time. So we have completely recovered from the sell-off of the COVID, and we're pushing the Z2 boundary. So this was really a powerful vote up for the market to start the week. There was some selling pressure early, so the fact that it's a strong finish shouldn't let us forget the fact that it did have a nice volatile ride down and then all the way back up. But the very strong finish is encouraging for the bulls. The 10-day look-back period then goes all the way from 342.90 all the way down to this week's 10-day low was made 10 days ago here at about 332. So that's like a $10, almost $10 range. So just under 3% from the 10-day low up to the 10-day high. Tomorrow the 10-day high raises up to 332.87, and then from there, 2 days from now, that 10-day low is going to be all the way up at 335. So this is a market that is getting compressed in terms of the 10-day range. So I still think we're in nosebleed territory. We've made an exceptionally long run. We've had over 20 days of the PSAR dot, pointing the way up. So that's been quite a bullish run. The slope of the dragon is favorable. The slope of the RL30 and the RL90 are both favorable. Prices closing on Z2. And so everything should be well. But that just makes me eager to make sure that I've locked in all of our ill-gotten gains here. So as I take a look now at the downside, what I'm looking for various support levels to decide where inside this move is it my money. I'm deciding that my money is going to be at today's low at a minimum. I could be tempted to go as high as halfway up the stack here, or at the RL10 at 340. Like I'm willing to give it, $2. But I would be willing to accept a one-day low. But I don't really want to give back anything more than that. I mean, this has been a real grind these last 15 days. And now that there's a surge in here, I'd like to take that opportunity to lock in the gain, so that if this was a false breakout, then I haven't given back any of the hard-earned gains here, that I'm just giving back the false breakout. And because I'd like to keep a piece of that, I could be tempted to move my intraday stops up in here to the RL10. I certainly would not let it go past the southern skin of the dragon here at 336.65, which is also the Z1. So I don't want to give back more than a standard deviation of the river here. So I can't see giving back. To me, that's as much as I want to give back. If I gave back the dragon and the Z1, that's still 1.3%. That's slightly over 1 ATR. And giving back all the way to tomorrow's PSAR at 335.6, or today's PSAR at 335 even, that already is feeling like too much. In fact, that's an area where I feel like I could even I could start getting short in here. Because in my view, I would like to have two positions short if it breaks the Bollinger Band mean. So at the Bollinger Band mean is where I would add a second short position right here. Oop, sorry. That should have been a red line step, sorry. The Bollinger Band mean, call it 330, is where I want to have a second short position, not later than that. I would even be willing to add it at the 10-day low. So if you were to add a second position here, I wouldn't be offended by that. In fact, that feels correct. And then add a third position at the Bollinger Band mean. That feels correct too. So I think that's what my trade looks like. So now if we were to experience a full 5% sell-off, so a full 5% sell-off would be this much. From the current price all the way down to the previous RL10 peak. That's 5%. This one is a 2.5%, and that's a 1%. So I like using those as sort of the guides for decision making here. The market's just been that good. That's the deal. So all systems go to the upside. What is there's no real resistance overhead, because we are literally at the RL10 peak of all time. And then you have to say that the Z2 line, anything beyond the Z2 line, is really irrational exuberance. So here's our Z2 line at 344. So anything north of this going towards Z3 at 351, call it, that's really irrational exuberance. And that's literally 344 is the RL10 peak all time. That just boggles my mind. I'm trying to figure out if that signals favoring a Trump victory or a Trump loss. I don't know that I don't think it means either one of those things. I'm prepared to just say that the Biden-Harris ticket is going to be so beholden to corporate interests that they're likely to keep pumping money to corporations. And so I think that's what this is reflecting. And that would be a return on investment of the big tech leaders that are heavy Democratic donors, since they realize that the Democrats realize that's the only place where money's being made, and they have to maintain the donor base. Maybe that's what we're seeing here, is this uninterrupted gains that seem to be disconnected from economic realities and the plight of the populists here. So I don't know that this is signaling a particular victor. But it's time to make hay while the sun is shining, to maintain pace with the corporate overlords here. So let's see what worked today. So the S&P came in at 1.01. Diamonds were better at 1.39. That was the big winner of the day, and the Russell was just fractionally better at 1.05. So diamonds moved up. There was some news today that 3 of the members of the Dow are going to be replaced. That's a pretty bold shift for the Dow. It's rare for them to make that many changes at once. 2 of the changes don't seem to be significant. They're swapping Amgen for Pfizer and Honeywell for Raytheon. So there's not much to choose from in between there. But the big move is that Apple's doing a 4-to-1 split, and because the Dow is price weighted, that means that there is a dramatic decrease in the tech exposure of the index from about 27% back to 20%. So Honeywell gets added in, and Salesforce.com gets added, and that can be considered technology. So that adds a little bit of technology back in at the expense of ExxonMobil. So ExxonMobil comes out, Salesforce comes in. So energy, which has been beaten down, ExxonMobil, has been replaced by Salesforce as a tech company, which has little overhead and is likely to be advantageous going forward. So that's an effort to bolster the Dow. That's scheduled to take place before trading opens on August 31st. So over the next week, you could expect some buying pressure, I think, in Salesforce, Amgen, and Honeywell. Honeywell's just a great company anyway. But that's what the U.S. indexes look like. So let's see what the sectors were better. So Japan and emerging markets were slightly better than the Dow at a little over at 1.1%. Let's make that brighter. Yeah. Consumer discretionary 1.5. Basic materials 1.76. Clean energy and industrials and triple tech at 1.8-ish. Finance, big day, 2.39. Energy, 2.75. And then the rest of it are all the companies that are really making standouts. So the one I just want to highlight is Boeing. We covered that extensively this weekend and talked about how to trade that with core and turbo, and that thing just crushed it today, right from the opening. The opening was the low of the day, and all it did was go straight up for 6.5%. So if you were trading the hybrid frog today, and we're using the swing trading one day at a time with Boeing and Caterpillar, we looked at. Caterpillar was pretty good. Boeing was just off the chart good. And we'd framed up U.S. Steel that was up 4.6. Energy and Devon up 3.5 and 3.2. We've been tracking Twitter. That was up 3%. Oil exploration, 3%. In the battle of the techs, the broad tech sector, TECL, was up 2.9. Triple Qs were up 1.85. So that was, it was actually a pretty broad performance because we have multiple sectors today that were better than the S&P. The metals did well. There's Nucor at 2.98, Cliff at 3, Alcoa 3.5. Here's Facebook up 1.6. Kodak works its way back to $7 with a 1.74. And then the old reliables, Apple and Home Depot, cranking it out at 1.2 each. So lots of opportunities to make gains today. Things that underperformed the S&P on a sector basis: Brazil and tech, just under 1%. The FANG companies, Facebook, Amazon, Apple, Netflix, Google, lagged at 0.77. Some of the tech leaders that didn't follow through today so much: Amazon, Google, Microsoft, and NVIDIA were underperformers. Cisco still can't get out of the rut here. It was down a fraction. Treasuries down a fraction. Mexico down a fraction. Intel down a fraction. So even the losers today didn't lose that much. Tesla and Nikola minus 1.7, wheat and precious metals minus 1.3, and then healthcare down minus 0.46. So today was a broad-based gains in most of the tech leaders, and then also featured finance, energy, basic materials, and consumer discretionary. So a broad-based strength today. That actually bodes pretty well for tomorrow because they're willing to buy everything. See if I can get, I do want to cover the Caterpillar. Let me load that up here. So we did a multi-time frame, multi-lens analysis on, I think it was Caterpillar, Boeing, IBM, Brazil, Diamonds yesterday. And we started off with the daily charts and looked at support and resistance and RLCO patterns. Then we drilled down to the 30-minute charts, down to the 10-minute charts. And so we're looking at how to refine our opening boxes. And while I'm waiting for that all to load up, that prompted Catherine to ask a good question in the chat room, and I want to cover this for her. So her question was, I can find it here. Had to do with the hybrid frog box in a gap that leaves the yellow zone. So I want to put this into, I want to tie a few ideas together and talk us through that. So this is that vertical blue line is the demarcation with the open. And as you know, we take a look at, yesterday's candle. So let's just a generic candle that looks like that. And so our mechanical entry would be 5 cents above. Our mechanical stop would be 5 cents below. And that would be treated then as the yellow zone. That until price, I should probably draw it more to scale. Sorry. Until price breaks out of the yellow zone, we don't have a directional bias. Like anything that opens. I should draw that carefully. Until price breaks out of that yellow zone, we don't have a directional bias because it's still in the same area in which the bulls and bears were fighting it out yesterday. But if it breaks out below that yellow zone, then we can think of this whole region here as the red zone. In the red zone, I want to be short, and in the green zone, anything north of that, I want to be long. And so this boundary at yesterday's low takes on real significance. And we're using 5 cents as a generic buffer to make sure that it actually makes a new low. And 5 cents above as the buffer. And so we call that the range risk. And so if I set a target generically up here of the 10-day high, and that's a legit swing target, I take this as my potential reward, and I'm using my range risk as my risk. And now I can say my reward to risk ratio is A divided by B. So that's the basic frame, swing frame. That is standard work for computing reward to risk ratios in a standard way. Now I can, no matter what the signals are, maybe I have a specific signal over here, like maybe a 5-day down, or a triple screen, or a washout, or a 551W, or a max pain range compression, or the auto framer. No matter what the signal is, I can compute this reward to risk ratio in a standard way, and then I can rank that from best to worst, a 1 to n list, on the basis of reward to risk. And then I can prioritize the ones that all of these patterns are tradable. And so if I want the best bang for my buck, it makes sense to use a standard way of evaluating the opportunity versus the risk. So range risk is how we think of that, just as a standard way. Now, it's entirely possible and reasonable for you to favor, hey, you know what, I really like the 5DD pattern for whatever reason. Maybe just that's a nice one for you to do. Or no, maybe I really like the channeling pattern or the overreaction because of reasons. So you might choose first, you might do pattern first, and then on the basis of reward to risk, or you might favor just reward to risk first, and then accept whatever pattern it is. What we do know is that all of these patterns are robust, and that the mechanical trade frame is a nice way to proceed. So when we're trading, swing trading one day at a time, what we want is an orderly entry. And what we define as an orderly entry is an entry anywhere in this yellow zone. We'd like to see it enter or open somewhere in that yellow zone. What that means is that the overnight news didn't create an exceptional condition where there was a large gap outside of the yellow zone. All right. If we see, therefore, if we see a gap outside of the yellow zone, then we're entitled to believe that is an abnormal opening. Like there was so much news that happened overnight that the reaction was so strong in the pre-market and in the futures that it moved price far away from yesterday's yellow zone, the normal area in which bulls and bears were fighting. Well, this is where we can now think about the gap and the measure called the gap stat. So the gap stat is nothing but the average of the absolute value of the gap, if memory serves, it's the last 30 days. It might be the last 200, but I think it's 30. And here's what we know about the gap, based on 20 years of statistical analysis, that the size of gap predicts size of follow through. What do I mean by the follow through? Well, if the opening is here, and then here was the day's range, and here was the close on that bar. Another way to draw that would be this open white candle in which it opened here and it closed here. So that's a net positive day. That had a follow through in the green of that much. So close minus the open equals follow through. So a white candle day has a positive follow through. A solid candle opened here and closed there. So that's a negative follow through because the close was lower than the open. Now, what we know about the gap then is that the size of the gap predicts the size of the follow through, but it does not predict direction. And here's why. When you see in this case a close here and it gap up open to here, well outside of the yellow zone, this is probably larger than the gap stat. And that says this is a large gap. If it's greater than the gap stat, that is a large gap. A large gap predicts a large follow through. We just don't know which direction. So when you know that there is a large gap, it's more likely that there's going to be a range stat move today, that there's going to be a big up or a big down. We just don't know which one because the statistics on this changes. Sometimes a large up gap predicts a large follow through. Other times, a large gap up predicts a big reversal. And the truth changes in as little as 5 or 10 days. But what we do, the relationship that is persistent, is if you have a large gap, you're going to have a large follow through on average. Why is that the case? I believe the explanation is this, that the amount of news had such a dramatic effect on the traders that everybody's treating it as real, and that creates momentum and follow through. So if it's a gap up and they believe that's good, even more buying pressure, tactical buying pressure comes in, and then you get a big follow through that's chasing that momentum. Or that big gap up is interpreted as a fake out, and then all of the professionals come in to slam it down, and you get a big follow through that reverses the gap, and then more momentum to the downside. So you get a big follow through to the downside. So when you see a large gap, recognize that it could be large up or large down. So now there's two ways we can use that information. Oops. So here's our nice little yellow zone. That was yesterday's range. Come on, Kenneth. There we go. And so we find our mechanical short, our mechanical long at that 5 cents. So I'm going to go long if it breaks out. I'm going to go short if it breaks down. Now, under normal conditions, what we're looking for is an opening somewhere inside that yellow zone. When we see that, we can take that little hybrid frog box and bracket the open, and then we can play the breakout here intraday, and then play this from our entry up to the mechanical entry as a tactical opportunity. Now, for that to be tradable, what we have to see is this region A, we have to be able to see a 2-to-1. So if my risk box is in here and I get long here, I have to be able to see 1, 2 risk boxes just to that mechanical entry. If I see that, do I see it? Yes, then I can trade it. But if the opening was so close to that mechanical entry that I don't have 2 units of risk, then I just have to wait for it to break out of the yellow zone and then just play it in the usual way as a mechanical entry. So what I actually really want to see is something that opens near the bottom of the yellow zone, near the bottom of yesterday's range. And then I'd like to see price maybe sell off, find support, and start working its way northward. This now becomes a critical state, and if I place my standard frog box inside here, I love this, because if this trade fails, then I probably have a collapsing dragon and I have a mechanical short. So I love that. But if it holds support and I can get this entry here, then for a very small risk box, I might be able to see 1, 2, 3, 4, 5 execution risks before I even get to the mechanical entry. Because remember, the mechanical entry is when, as a swing trader, I'm justified in adding swing trading position size. So now I have the best of both worlds. I have a turbo trade that has plenty of room inside the yellow zone, plus a core position that I will pick up because it gave me a swing trade entry. So now I'm getting core plus turbo. Then as this thing goes up and then there's some sell-off, and maybe that's enough to get me out of the turbo trade, now I can use all of the money that I made in here to fund the core position that has an entry back here. And up that goes. And as long as I don't let that get negative, I have enough wiggle room in here to give it time to recover and go on the basis of the market's money that I'm using for the risk. So this is typically 1/5 of the size of the turbo trade. So if I had 1,000 shares on the turbo, because I have such a tight stop, then maybe I cash 800 here and lock in gains, and then keep 200 for the overnight swing, paid for with market's money. So I have reduced the risk to my seed money, my personal core capital, and I'm using market's money to fund the risk that I'm taking with the 200 shares. And then using end of the day data or 30-minute charts or hourly charts, I can manage this trade as it goes up and then adjust my stop using swing trade in a more relaxed approach. Whereas in this region where I'm really fighting for pennies, I may be using 1 minute or 3-minute or 5-minute charts because I'm being very tactical with a tight stop. So that's the normal way that we would like to trade an opening that happens inside the yellow zone. But now the special case is Catherine's question. Hey, what happens if there's an abnormal entry and it's outside the yellow zone? So I actually like that even more from a turbo trade perspective. And I'll ask you to imagine what I'm about to say while I set up this chart. Blue. So there's my blue vertical line stalking. Here is yesterday's candle. There's my 5 cents below, my 5 cents above. Here's my whatever that 10-day high was. So based on range risk, and reward, if that's greater than 2-to-1, then that's got swing trade potential. And again, in an orderly opening, I can trade inside the yellow zone if I can see. Can I see 2-to-1? If so, then turbo. But now what happens? Now Catherine's question is, what happens if I get an opening outside of the yellow zone? Again, that means that there was some news event that caused this thing where it closed to open all the way down here. If you saw that, that's surely greater than a gap stat. And that means large follow through is coming. This is one of those times. Remember, we said only one time out of 6 have we seen a range stat move. And the range stat is the average range plus 1 frog box. So that's a big move. So if we saw a large gap, there's a real good chance that this thing is going to move plus range stat or minus range stat. I just don't know which direction, but the probability of a range stat move just got increased. So here's what I have to do. Because there is no orderly opening, that means I cannot swing trade this. The swing trade version says it opened inside the yellow zone and then proceeded outward in an orderly manner. But now it's already gapped outside. That means no swing. But it means double plus good for the turbo trade, because now I can have a very tight hybrid frog box or minimum manageable risk box. And now when I play that tight box breakout, whichever method I'm using, I now have an increased probability of the R stat move, that range stat, either positive or negative. So the short answer to Catherine is, if it gaps outside of the yellow zone, then no swing, but double plus yummies for the hybrid frog turbo. And when I say hybrid frog, it's either a hybrid frog box or the MMRB. Anytime you have that large gap, that's the day you want to be day trading and emphasizing the intraday move. And then be cash overnight. Let the swing trades sort itself out. Let those guys come in and make their decisions. But for the first day or so, while it's processing what all that news means, until it comes up with a real directional move, you can just take advantage of the increased intraday volatility and just trade that one. So now you should be asking, hey, Ken, is it a strategy for me simply to take all of the members of my herd and find out which had the biggest gap and then look to day trade those, the ones that have the biggest percent gap? Yes, that is. That's what that TC2000 bundle will do. It'll tell you if it gapped larger than a gap stat, because remember, that's geared to each individual symbol. So you can go hunting for big gappers. You find the big gappers, and they're either going to be a big up follow through or a big down follow through, and you can day trade one day at a time just by studying the gap stat. That's hybrid trading. Now, if you have something that was a swing trade pattern and it was a big gapper and it was a frog champion, holy mackerel. You know, my best day in life is when Brazil is on a swing trade pattern and is a big gapper, because that's good for intraday and turbo and swing and directional, and all signs point to yes. That's the day that I want to be a great day trader, is when I have a frog champion, one of my old reliables, that is on a formal swing trade pattern like a 5-day down and has a large morning gap. That's going to be a good day at work. So Catherine asked a very good question, and there is your hour-long hybrid trading lesson for the day. Any questions on that? Just go ahead, chunk them into the questions. Now I want to give you an example of that. Here's what happened with Boeing. Yeah, Van, that's going to go in the that's going to go in the 2R battle drill and the kata number 1. Yeah, yeah. So this was the Boeing frame, and remember, we didn't know it was going to do this. We didn't know that it was going to open here and then go straight up and close here. But what we did say was we recognized here was a swing high and a swing low in the previous swing high. We said it would not surprise us for Boeing to move up here and challenge the PSAR dots. And the reason we thought it could is that it had sold off sharply and then rebounded sharply and then sold off sharply, but then held 1 day and 2 days here at Z1. So we saw that day the mechanical risk as a very short or small risk box. And so we framed the trade, the mechanical trade, 5 cents above and 5 cents below. So if this thing had broken through the Z1, then we had every reason to believe it would come down and test this. So I certainly want that one. That's a great trade to the downside. That's a move from 167 down to 158. That's $9. And if I could manage a $3 stop, that's a 3-to-1 short side trade just coming back down to here. And then if this collapsed, then I have a collapsing dragon and I can get a second position in here paid for with market's money that I made on the way down. And then this would be a massively good trade. So I really like the trade to the downside. But if this thing were to go to the upside, I like that trade too. Why? Because I would have seen a swing low, a higher low, and then if it takes this out, it feels like a up, down, and up. That lazy W kind of deal. If I saw a swing low and a higher low, this would be amazing. And if my risk box is here and it's going to come up and test those, I have at least 2, maybe 3 units of gain. So I like this trade to the upside. The next thing that we looked at was we looked at the size of some 1-day trades, 1-day ranges. Hey, there's a big one where it went from here all the way up to here. And it's still at that same price level. We said, yeah, that could get up to here in 1 day. And that's exactly what it did. It gave us one big direction. Here's a big directional day. Here's a big directional day. Here's a big directional day. After a big sell-off, it found support and then rebounded. So that's characteristic of Boeing. People coming in and making these great big one-day moves. So for a risk of about, call that 171, and call this one, 168, there's my $3 risk. And coming up to test 180 is plus $7. So that's 2.3 to 1 to the upside and 3 to 1 to the downside. Guess what that is? That is a critical state. This little region right in here creates a critical state. A higher than normal probability of a large directional move in either direction in a short period of time. Yeah. So that was Boeing, and all it did was exactly what we framed in one direction. Didn't predict it, but we were prepared for it. And this is what that move looked like. So framed in the usual way, we come over here and we find that period of time when it has that minimum manageable risk box. And the idea behind it, this is like an engine that's just idling. There's no directional move, and it's just moving in that Z3 channel like that, just normal market grinding noise. So we can come over here to the opening, which was, let's see, this blue. So the blue line is the open, and we can take that box and we can frame it in either direction. We might have, if we were trading it purely by hybrid frog, come on, work with me here. We might have taken this position long. We might have scratched here, but then the re-entry on this move looks like this. So even if we get long and then scratch or take the short loss, here's the re-entry. And then using that minimum manageable risk box, there's like 1, 2, 3, 4. You might have taken that as a sniper here and cashed 4 execution R. But if you were that quick on the trigger, then you should be taking this as a re-entry, and then you get another 1 or 2 to the upside. So there was anywhere from 4 to 6 execution R right from the opening gunfight. And that is, here is this little move here. That's a supported fall crossing or supported summer crossing. It's going to be one of those two patterns. And then if you, let's see, clear the ink on this one. If you play the supported summer crossing here with a stop down here at the PSAR flip, you keep that in place until you get three dots, 1, 2, 3 above your opening or your entry. Then you move that up to here. Then you pick up the Bollinger Band mean. And you get this much gain versus that much risk. And that's probably 1, 2, 3, 4, 5, 6, 7 XR. And you might have added a second position here or here or here. You might have gotten 1, 2, 3, 4, in which case you probably got 7, 4, 2, and 1. You could have picked up potentially 14 XR if you just trade this in the normal way. and all geared off of the standard trade framing, one swing trading one day at a time by finding Boeing in that critical state. And the main point is that this tiny little risk, price action here and it's worth. This looks like a dog's breakfast right here, but we use this shaded box approach to go through the discussion of how to frame the trade in Boeing in about 5 minutes. So listening to the Sunday night trade framing is certainly worthwhile. And then you can see how we applied that lens to Caterpillar, and there were a bunch of things that performed like this today. I think U.S. Steel was one of those. Yeah, it held support at the PSAR and gave us a nice big directional move. Caterpillar was another one that I recall that we did last night. And Caterpillar was even easier because we had seen the support level already hold here, and then the next day was already a day up. So we were buying the second day of momentum. So what we saw was, with this big yellow box and orange dot, we were prepared to trade. Whoops, wrong thing. We were prepared to trade long or short out of the yellow box, and we were ready. We were ready to follow price action in either direction. And it just so happened that in this case, the direction was nice gap up, and then a great big favorable move that closed well above the dragon. So this one is actually well postured for a continuation pattern tomorrow, because now we can look at this and say, you know what, if it takes out the RL10, then I actually am ready to take an additional, dang it, wrong thing. I'm ready to take an additional entry here, because it will have broken. Come on, Kenneth. It will have broken above the previous peak of the RL10. So that if it breaks above that, we now have new information that this thing is breaking out to new highs. And if that's the case, then we can take a look at the 10-day high as the next price to the upside. So we could be looking for this to go to 146 if it breaks above 143. Now, that's what it looks like on a day chart. So I could actually drill down and trade that one on the shorter time frame using core and turbo techniques. So this is how we stack up all of the favorable price action. The final thing that I want to just show you on this one is that when we were framing this thing 2 weeks ago, and when we did that, we saw that the trade box was this. But guess what? It broke out of that today. So any follow through tomorrow is going to be an important move above what had been the trading range. Here it broke out and then failed back into the trading range. But now it held a low, a higher low at the Bollinger Band mean, and today it broke out of that box again. So this already feels stronger than the last move. But remember, the last move went from 131 to 146. That's a 10% move. And this thing has only gone 5%. So there's another 5% to the upside, which is another $7 from 140 2, this thing could go to 149 and not be irrational. So Caterpillar, not a tech stock, just a big old dumb cow industrial, but that thing has a frog champions kind of swing trade patterns. You can see that we've been using this kind of box technique, this visual box trading, to help us frame what's reasonable and where the decision points are for critical states. So that's the point I want to make about that one. Okay? So many goodies out there based on today's favorable price action that it'll be fish in a barrel tomorrow. I just don't know which direction. So if there's a big gap tomorrow, then I'm prepared for a large move in either direction. No, once it breaks out of the yellow zone at any time in the day, as long as it's not the last half hour, that thing is tradable. And this is a condition-based rule that there's a lot of folks that are like us, gearing their price decisions on the basis of achieving a price level regardless of time. I would wish that it did it in the first 30 minutes so that I have more of the day session to get more of the gains. So sooner is better in general. But there's not a period of time in which I no longer pay attention. Anytime it breaks out of yesterday's trading range, that has a very special significance for me when it comes to swing trading, because it broke out to a new price level that it couldn't get to yesterday. That's new information has come to light, to quote the Big Lebowski. New information has come to light, man. That's the sound of me rehydrating with my electrolyte electrolyte replenisher. Man, it's like drinking energy, but healthy. No sugars. Just all the electrolytes that get depleted when you work out. All right, so that's the lesson. Let's get to the daily now and see what we can see. So we're looking for the report as of 8/24. We're going to be concentrating on the primary pages that give us the primary resource for developing plans. The subsequent pages are just dealing with more technical elements. So we're going to concentrate on the ones that we like. Bullish, overbought. ADX is still strong. The risk Z pointing to the upside. It was the non-tech leaders today. Verizon, Diamonds, Visa, Nike, Procter & Gamble. Still have a few tech companies in the stack that are Max Paynes and some energy companies. Lots of symbols that have a long way to go to get back to their 10-day high. So that's where you see things like, the Cisco move. So Cisco did not participate today. It was down a fraction. And it was a doji. So Cisco was still poised. It didn't have its breakout today, but it could tomorrow. On the other hand, Apple was just massive goodness today. Continues to be great. There's Boeing's big move, 6%. There's DuPont's big move, 5.8%. There's some couple 551Ws. There's a triple screen in United Health, and it's channeling. So that little sell-off today of minus 1.7 now triggers an alert that we may be able to be framing a trade that buys on a dip. So most of these mechanical swing trades over here are based on a pullback of some type. There had to be something like There had to be a strong move up, then a sell-off, and then that puts it in a critical state where it's either going to go up or down in a big way for a second leg down. So that's what constitutes a critical state, and that's what you get when you have a lot of these channeling overreaction, washout, 5-day down, triple screen, 551, max pain, and max pain range compression in the auto framer. These really favor things that were strong but now have pulled back and are either going to resume or they're going to further collapse. So you get a sharp move in either direction. Boeing was like that, and it just happened to go up, so we just followed price in that direction. In the ETF tactical, again, handful of dojis. Gold is interesting as it's 2.7 to 1 on the auto framer. It was channeling, and it's a triple screen. Brazil is a max pain, and it's 4 to 1 on a retest of the 10-day high. And that's even after it had a nice little bump today. But the big winners, energy, finance, oil exploration. XOP looks especially attractive at 2.3 to 1 reward to risk. And the energy also ready to pop. So between the energy sector, finance follow through, and Brazil, there's 3 or 4 very good, least correlated indexes that are prepared to pop tomorrow in either direction. So these in the green are the symbols that are your relative strength leaders with respect to where they are compared to the river. And by the same token, Cisco is especially bad compared to all its peers. It's the only one that's out of the river to the downside. In the auto framer, you still have plenty of symbols that test out well on the reward to risk. And then this framing data gives you all of the mechanical entries and stops and the 10-day high that allows you to frame those trades rapidly. The regression line fractal gives you the ones that are exceptionally value plays the most number of ATRs below their RL270. These are, likely candidates for deep value plays or a continued failure. So Intel, Cisco, United Health, they might just be so bad that there's more pain to the downside. And then the ones in the bottom shelf, the most ATRs above their 270, these are the relative strength leaders. McDonald's, Procter, Apple, Home Depot, and even Boeing is now looking pretty good. McDonald's is 10 ATR above its long-term fair value. Apple is 8. So here's a case of Apple just absolutely crushing it. This is where our swing trade previous position was put in around 460 when it failed to fail and started breaking out to the upside and took out the previous RL10. That's the auto re-entry or the auto additional position, which started down here on the supported summer crossing, and then an additional entry here. So now if you're trading Apple, to me, I want to lock in that move right there. I am not going to let much of that escape. That's such an exceptional move. And it already started selling off today after the big gap up and then came back to Z2. I'm going to use the just a fraction above the low of the day. I want to get paid in here. That's where my stop is at 500 even. I'm only giving it $1.50. All right, the daily squeezes, these are ready for a large intraday pop. So that's good. Visa, Brazil, Intel, Microsoft. Brazil is a nice frog champion, and Microsoft is always one of our favorites. And here again is your this is the size of the range risk that you would take. Most everything in the fall and the summer, so they are above their zero line. But these in the summer have had less pullback than those that are in the fall. Now that's really a double-edged sword. If it's already fallen, then there's more room to recover back to the 10-day high. But if it's in the summer, it didn't even sell off, and that's where you see things like the Qs and XLK and consumer discretionary are just so attractive because they are still strongly into the summer. There's the Qs, and then there's XLK. And then similarly over here, these that are in the summer are your relative strength leaders. Microsoft, Amazon, Apple. The ones in the winter are definitely getting smashed. So those become candidates for shorting. If the market were to sell off, then you would expect the weaker symbols to lead the way down. So even though we may not be trading these to the long side, there is information content in that part of the report. All right. So we're about an hour and a half into this thing. I want to give you time to prep your own stuff. So that's everything that I want to cover for tonight. I will get this published and posted in the usual spots on Patreon, and we'll get that posted tonight. So thanks so much for your kind attention, and we'll be ready to crush it tomorrow right from the open. Okay? Take good care.